Welcome to today's episode. In this session, we're exploring how inflation, something we all experience in our daily lives, affects the stock market. Whether inflation is rising gradually or spiking unexpectedly, it plays a major role in shaping investor behavior and market trends. Inflation is the rate at which the general level of prices for goods and services rises over time. Moderate inflation is a normal part of a growing economy, but when prices rise too quickly, it can create uncertainty and stress for both consumers and investors. Central banks like the Federal Reserve monitor inflation closely and adjust monetary policy to keep it in check. Higher inflation affects the cost of living. As prices for essentials like food, gas, and housing rise, consumers may have less disposable income. This can lead to reduced spending on non-essential goods and services, directly impacting company revenues, especially in retail, travel, and discretionary sectors. At the same time, companies may face rising costs for labor, materials, and transportation. If they can't pass these costs on to customers, profit margins shrink, which puts downward pressure on stock prices. When inflation rises, central banks often respond by increasing interest rates. Higher interest rates raise the cost of borrowing, which slows business investment and consumer spending. For the stock market, this typically means lower valuations. Future earnings are worth less when discounted at higher rates, especially for growth stocks that rely on strong future performance. Inflation also impacts investor psychology. When inflation feels out of control, markets often react with increased volatility. Investors may rotate out of equities and into assets like commodities, gold, or inflation-protected bonds. Stocks in sectors such as utilities or consumer staples may hold up better, while sectors sensitive to rates, like tech, can see steeper declines. In summary, inflation affects the stock market in several interconnected ways, by reducing consumer spending, increasing business costs, prompting higher interest rates, and shifting investor sentiment. While some inflation is normal, rapid or unpredictable inflation creates uncertainty, which markets don't like. That's why understanding inflation's role is key for any investor navigating today's economy. That wraps up today's episode. If you found it valuable, be sure to subscribe and share smart money insights with your friends. Until next time, make smart moves with your money.